Welcome everybody to this video where I will be analyzing the current situation of Douglas AG, an interesting company with some lights and obscures in the financials. Douglas is a German-based company in the cosmetic and beauty sector, acting as a retailer. The firm activities are in Europe. Just to cover a brief introduction to the cosmetic and beauty world, the sector is expected to grow at a rate of 3.3 to 7.7% annually, which actually Douglas was able to beat until 2025. The trends in the sector are that the main brands are entering in the retail sector as well to gain full control of the customer experience. This is because customer experience has become one of the primary differentiators for the brand. And this can be seen in cases like Sephora, which is the main retail business from Louis Vuitton. The business cycles are considered to be quite defensive because of the sector growth that has been consistently beating the GDP growth. And additionally, the sector has high margins that allow them to still be profitable in the lowest moments of the cycle. Even during 2022-2023, there was a boom. And now the sales are, the cycle is not so much in the boom, so we are not seeing anymore a company in the peak of the cycle. Just to get an overview of the competitions, Sephora is the main player, comes from a subsidiary from Louis Vuitton, so it's on a full amount of its brands and has exclusivity with a lot of their products, which is a very important competitive advantage. This is why Douglas, to compete with those main players, is frequently trying to get exclusivity agreements with brands to gain independence from other retailers and as well loyalty from their customers. And then there's like other minor players like Marionov, but that are a little bit less relevant. So following strategies like Douglas as well. To get an overview on how Douglas is doing against the competitions, I took Sephora as a comparison. Both companies have been growing significantly during the last years, but Douglas grew slower until 23. Now it's reversing. Douglas is the one growing faster, but we can also see, strangely, that Sephora is almost flat during the last year, but at the same time has better margins in net income. As one of the reasons could be that Sephora is a more high-end brand, but I could not get that much financial information of Sephora because it's not individually listed, it's only listed through Louis Vuitton. But also could give us an idea of what a retailer could have as margins. In the P&L, we can see that the EBIT, the activity of the business, has been growing until 2025 with margins around 8%. Keep in mind that during 2022 to 2020, the company registered some impairments, which are one-off losses that doesn't represent a cash outflow, but it's always healthy to see that management is making corrections of the valuation of their assets. So this is actually healthy from time to time to see impairments as well. On the EBIT, we can see that the company is expensing a lot of money in interest payments. In 2025, with the interest rates decreasing, this definitely benefited a lot Douglas. And if we could see this trend still going on, this definitely will benefit a lot the company for 2026, but we will see how it goes. I didn't add that information in these presentations, but the company already reported Q1 result of this year, which is, by the way, the most important quarter because it includes the peak holiday season. And during this Q1, the company performed worse than last year, reporting an earning per share of 1.35 versus 151 of last year, even if actually the sales grew by 1.7%. Looking at the segment reporting, we can see that Douglas is focusing his strategy in Central Eastern Europe, where the sales more than doubled since COVID. And then we can see that France and Southern Europe are quite flat, and Dash is still growing steadily. In the channel sales, we can observe that the company still relies strongly from the store sales. During COVID, they had to close significantly amount of stores, but thanks to a higher sales per store and a gradual reopening of the stores, the physical channel is still growing. Looking at the cash flow statement, we can see that the company has a lot of cash outflows in its financing activities. If we took the repayment of borrowings and the proceeds from long-term debt, we can see that the company is slowly paying its debt, even if in the past years they had to even rely on capital increases to do so. We can also see if we had the rent payments of the stores and the cash from investing activities, that the amount is higher than the amount of amortization and depreciation, which is good, indicates that the company is still expanding its business and its assets, which in this case is mainly physical stores. In the balance sheet, we can see that the company is quite an asset-light business. The main assets are PP&E, goodwill, and stocks. On the liability side, we can see the company after COVID had significant losses that stressed a lot the equity, even getting it to negative equity by significant amounts. In 2025, the picture is healthier, but the company has still a significant amount of debt, which is quite concerning. In the debt ratio, we can see that the company has been reducing the financial liabilities, which is a good signal, even if it's by a small amount. The company is able to finance its growth and also reduce the debt, which, it's healthy to see. On the other side, the lease liabilities coming from IFRS 16 are related to the rents of the stores and the future payments of those. As long as they keep reopening new stores, this amount will still grow, so it's less concerning than the financial liabilities, but overall we can see that the company is very highly leveraged, which is definitely a risk. And if we took the cash flow generation from the business, excluding growth and external factors like financing and the EBIT minus tax, we can see that Douglas has a lot of potential to grow the net result just by reducing the debt. And actually, if we compare it to the capitalization of the company, it could be trading at very low ratios, even keeping in mind that the company has done a poor Q1 and is definitely not free of risks. In the ownership structure, we can see the founding family still present through Lobelia Lux with a 12%, and then we see CVC with a 58%. CVC is a private equity firm. Those funds typically aim to have an exit on their investments. Usually after 2 to 3 years post-IPO, those equity firms usually sell the position, and the IPO was last year. So this is not a risk for the business, but could be a risk for the valuation of the company, since the biggest shareholder might want to exit his investment. And then finally, for the remuneration of the shareholder, the policy is to distribute up to 40% dividend payout if the debt ratio is under 2.5 to adjustment EBITDA. Currently, the ratio is at 2.9, so we are not there yet. But yeah, we will see how is Douglas able to perform, and I leave to your judgments to see if this is a good investment or not. Thank you very much.